You're seeing competitors like Tesla cutting prices again and again and again here in the States. And how is that pressuring the business? Do you guys see the need to continue to respond to that? Is that going to be a problem going forward?
We are seeing massive demand for our products. So after we launched them and started production, we saw that we needed many, many more. And so we had to invest a lot of money to increase the production. And that you mentioned earlier, the Lightning, for example, is going up to 150,000 this year.
Ford is now delaying production at its second battery plant, which, as you know, is brand new in Hardin County.
We are also slowing down several investments, including making a decision with SK On to delay the second Blue Oval SK JV battery plant in Kentucky.
The slate of automotive Q3 earnings reports hit the wires over the last week, and the OEMs are raking billions of dollars. But looking at the stock market today, the shares of these companies aren't doing so hot lately. Why is that? The answer is the market has finally come to terms that the costs these legacy car companies have taken on and future costs they'll be subjected to will overtake their profits unless drastic steps are taken to shore up their margins. The headwinds these companies are facing can be categorized into macroeconomic factors, electric vehicle price wars, and labor costs.
I'm worried about the high interest rate environment that we're in. I just can't emphasize this enough that for the vast majority of people, buying a car is about the monthly payment. And as interest rates rise, the proportion of that monthly payment that is interest increases naturally. If interest rates remain high, or if they go even higher, it's that much harder for people to buy the car. They simply cannot afford it.
Tesla detractors love to bash Elon Musk whenever he rants about interest rates affecting demand of high-ticket items on earnings calls. They might argue that other auto manufacturers don't need to cut prices in light of higher rates or to spur demand. But to be fair to Tesla, the company just has much more transparent pricing. Compare that to buying at a dealership where you have to jump through hoops just to get the best price. A great example of that lack of transparency OEMs take advantage of is offering greatly reduced interest rates as specials. If pickup trucks are the most popular type of vehicle they sell, would Ford, GM, and Stellantis need to offer incentives to move metal? Ford is offering 2.9% APR financing with $500 cash back and $500 on your trade-in value for a new F-150 XLT. GM is offering 3.9% APR on their Silverados, and Stellantis seems the most desperate, taking $4,000 off a Ram 1500 Bighorn, or you can pick 0% interest rates. Remember, interest rates are much higher than 0, 2.9, or 3.9%. With DealerTrack finding the average new car loan rate is 9.89%, as reported by the car dealership guy, who is a leading voice in the automotive sales world.
Well, when it comes to demand, a lot of that comes to affordability and the ability to take on new loans. And I'm reading your notes here. The average loan rate for a new vehicle edging toward 9%, listing prices above $47,000. At what point do consumer credit implications have a negative effect on here? I'm not necessarily asking for a repeat or your a comparison to 2007, 8, and 9, but that's the most obvious example when we saw credit strains here. So what is that like, and how does that affect the demand picture down the line with these elevated interest rates?
You might see rates advertised in the low fives, but it would require an impeccable credit score, and that is tougher and tougher to maintain with cost of living going up every day, it seems. Credit card balances are at record levels, and delinquency rates on that revolving debt are on the rise, with 5.08% of balances falling behind on payments by at least 90 days. Car loans aren't faring any better and are not just rising, but hitting levels unseen in 30 years, with Fitch Ratings research showing 6.11% of auto loans being 60 days late. Maybe you're personally not feeling the pain, but the number of people who are is growing, and interest rates don't just dissuade people from buying cars, but the fact that interest rates are so high is symptomatic of inflation, destroying the ability for ordinary Americans to buy the bare necessities. Perhaps you're not a Tesla fan and you hold stock in the OEMs. Well, regardless of your automaker affinity, you have to admit, with lower interest rates, that would mean your favorite car company could sell more cars.
That echoes comments earlier in the week from Porsche, which said the luxury sector wouldn't be immune to global economic worries.
The market thought the rich in the luxury segment that caters to them would be immune from interest rate pain, but it's finally catching up to the top percentiles. Porsche reported earnings this week, and its CFO, Lutz Mesk, echoed Elon Musk's concern for rising rates, saying, "Governments increase interest rates heavily. That creates a situation where customers are quite reluctant to invest in a new product." Mesk continued with a warning for the luxury sector as a whole, adding, "You can follow it when it comes to the share price development of all luxury retails worldwide. which may be an allusion to the likes of Louis Vuitton stock falling from $200 a share to $140 in just a few months.
Mercedes-Benz says the market for electric vehicles is getting brutal, and it warns that could bite into profit margins over the coming months. The luxury car maker on Thursday posted a near 7% drop in pre-tax earnings. Mercedes said fierce price competition and supply chain issues were making the EV market a tough battle.
Sticking to the topic of luxury brings us to Mercedes-Benz, whose shares were not immune from the selling pressure that all the other automakers were experiencing. Their CFO, Harold Wilhelm, coined a fitting description for the electric vehicle market, saying it was, quote, a pretty brutal space. He continued his thoughts about the contentious pricing environment Elon Musk's Tesla has started at the beginning of the year, saying, I can hardly imagine the current status quo is fully sustainable for everybody. Well, I think it's sustainable for Tesla because their margins might be shrinking, but they're still profitable. The German automaker stock price fell after reporting less than expected revenue, car sales, and EBITDA, citing supply chain and EV pricing challenges.
But when companies like Tesla comes out with a price war, can you afford not to engage?
Yes, well, I think the price competition, which is rising from Tesla and also expand to the other OEMs, but somehow there should be some other points that we have to see in a different way. Yeah, that's why I just mentioned earlier. We focus on the more customer value.
The Korean competition in Hyundai and Kia are big players in the EV market and have just entered the arena with Tesla, looking to go toe-to-toe in their price war. The 2024 Hyundai Ioniq 6 now is $4,100 cheaper than the previous model year, which means you can pick up a new one for $38,615. What Car and Driver conveniently left out of the article about their, quote, EV of the year is that the 2023 Ioniq 6 was not selling, forcing Hyundai to offer a hefty $5,000 rebate for the model this past summer, which allowed you to buy a new one for $37,000, with numerous other incentives, including a 1.49% APR plus a $2,500 discount offer. Startups aren't faring any better in the EV price war. Fisker just released their Ocean EV SUV in June of this year, and in October, they're already having to reduce prices on their Extreme trim by $7,500, bringing the starting price to $61,499. CEO Henrik Fisker commented on the need to cut prices, saying, it is essential Fisker responds to the competitive realities in the rapidly growing EV market. To get a better perspective of how brutal the price war really is, the top-level trim Model Y is faster than the Ocean Extreme by Fisker and costs $6,000 less. Hyundai's spec-to-spec comp isn't that great either when going against the Model 3 sedan from Tesla. The 0 to 60 time is over 7 seconds unofficially for the Korean product and goes against the 5.8 seconds for the Model 3 rear-wheel drive, which also has more EPA estimated range, 272 miles versus 240 miles for the Ioniq 6 rear-wheel drive. So why all of these incentives and offers? Well, these building inventories on lots are becoming problematic for dealers who are likely pressuring manufacturers to reduce prices. Dealers use lines of credit or loans to buy cars from manufacturers, and as you can imagine, the amount of cars they buy, they're highly exposed to interest rates. Car Dealership Guy from X shares insider information from his industry with a text message showing the pain dealers are experiencing with higher rates and slower moving inventory, with this specific case being a 13 times increase in financing costs. I guess it's probably best for OEMs to save their dealership network by taking losses on cars to get them sold and replaced with cars people might actually buy.
There is a oversupply of electric vehicles in the industry today that is greater than the demand.
Pickup trucks went from 52 days to turn in January 2023 to just 57 by August. Meanwhile, the EV supply was closer to 90 to 100 days. No segment has seen a rise as substantial as EVs.
With the UAW strikes in headlines for weeks now, labor costs can't go ignored when speaking about the headwinds OEMs are facing in their struggle to become profitable, especially in their EV segments, or really, just in their overall business. We highlighted Ford's increasing costs yesterday with their tentative agreement with the union, which would add $1.3 billion in wages and benefits per year. That figure amounts to a typical quarter of net income for the company. It seems like if you're one of the Detroit Three, you're in a tight spot and you need to trim expenses and lower spending in some other area of the business to afford these UAW wages. EV plants are the most obvious places to start cutting. Ford announced $12 billion in EV investments are to be delayed, which include development of new models, battery factories, and factory refurbishments in an effort to pace production with demand. We've talked about GM and Stellantis pushing back their plans for their EV pickup trucks and SUVs. But add to that the announcement that General Motors and Honda have terminated their partnership in the development of an affordable electric vehicle. Honda CEO Toshihiro Mibe said it would be a difficult business making an affordable, smaller crossover EV, and that Honda will try to develop a cheaper car on their own. Mibe implied that cost and range were the reasons for canceling the agreement with GM. Across the Atlantic, Volkswagen has canceled their new EV factory in Wolfsburg. The German carmaker will now integrate their new technology and model lineup in existing plants, which mirrors Tesla's plans to expand their existing factories' capacities to keep capital expenditures in check during this high-rate environment. But unlike Tesla, VW is needing more than just capex reductions. So in that effort, they're cutting jobs. Austerity measures are being negotiated with their union, with 30,000 jobs at risk. The company is just not profitable enough, with their CFO Arno Antlitz during their earnings call this week saying, "We cannot be satisfied with our profitability, which dragged behind our ambitious targets in the third quarter." VW cut their profit margin outlook for the remainder of the year as well.
Look, the way that I can prop up my profitability going forward is when you get your software upgrades. I can charge you more for that, but of course that all comes down to some autonomous driving as well.
Yeah, you know what's so interesting is that on first blush, you're like, ooh, maybe it's a demand problem. But I think you're totally right. He can do it. Like, he can undercut the competitors, and particularly the ones in the US. He can do it. It also shows that he can also change the price on Monday and actually raise prices. But the idea that, like, I can just make these cars cheaper and I can deliver them, therefore, thus, this is the new model.
And in such an incremental manner. I mean, it feels like every week, if not every day. I think it was only a couple of days ago, he stripped down some of the price point on the new extended range Model Y. So,
ever since January, Tesla critics and Tesla shareholders alike lamented at Tesla price cut Thursday, the day of the week Tesla usually adjusts pricing, as it seemed like over and over throughout 2023, the lineup got cheaper and cheaper. Despite drastic double-digit percentages in price reductions, Tesla still remains profitable and is on track to grow sales by 40% year over year. The claims of the competition is coming still echoes through the recording studios of CNBC, but reality checks are appearing at blistering rates over the last few weeks, where not just OEMs, but startups as well feel the pressure of Tesla's price war on their lack of profitability.